If you want to know what an old investment banker thinks are the 8 stocks to buy right now that have high growth potential and that actually have pretty decent valuations, this is the video for you. I'm not just going to tell you, oh, I like this stock, or I like that stock. I'm actually going to show you the data points. I'm going to show you how I do the research so you can learn, become a better investor, and you can do this on your own. That's the whole purpose of this channel. Our mission is to make 1 million people financially free. Felix here. Let's get cracking. Before we do, I want to encourage you to come and learn to be an even better investor and trader. And you do that by, well, learning what we've done. So say last year we did 105% return on capital employed. The year before we did 126%. You might be thinking, well, 2 times lucky. Well, this year so far we are up about $4,000, and that's on a approximately $30,000 portfolio. So you do the maths on that, we're doing all right. And I'm going to teach you the exact system, the exact 3-step process that any beginner can follow that's automated. So we spend maybe 2-3 hours a week doing this. Come and learn the system with me. It's completely free of charge. felixfriends.org/webinar. Join me for about 90 minutes of fun and games, and I'll break it down for you. Now, stock number 1, this is one you've heard of. I think this has been mentioned recently, but we'll also throw in a couple of hidden gems, which I think are worth looking at to kind of just broaden your horizon. All right, NVIDIA. Everyone's saying, oh, NVIDIA is overpriced. It's insanely expensive. You're too late to the party and all of that. Well, let's have a look at it. The business has amazing cash flow. It has amazing growth, and it's more profitable than anything, really. I mean, literally. I mean, there are like drug dealers in Colombia going, I wish I would have invested in NVIDIA. All this powder is worthless. That's how profitable this company is. And it's not insanely expensive because, well, it could be E or F. This is like school grades, right? A to F. And D is kind of like, all right, with an A, profit health, this is actually a pretty decent result. Let's look a little bit deeper. You know what they do. I think unless, well, you've just come out of a coma, I don't know where to start. Ask ChatGPT. Ask Google what ChatGPT is and then ask them what NVIDIA does. But the margins are like, oh my God. I mean, it's insane. It's like a software company that happens to sell hardware. That's how the margins look. It's just out of this world. Half of the revenue is just pure unadulterated profit. And return on invested capital, 64%. And profits growing at 31%. That's just madness. And it might make you think, well, maybe the stock should go up 31 to 64% a year. At the moment, it's doing that a week. But, you know, the stock's doing incredibly well. And of course, don't do drugs, children. I never do drugs. Never have. Never really appealed to me. The lack of control. I'm a control freak. So one more glorious thing on this free cash flow, 27 billion. It's like, they don't know what to do with that money. That's probably why they're financing purchases for clients. And if you want to just call up NVIDIA and say, I'd like to buy $1 billion worth of your chips, but I haven't got any money. Can you lend me the money? They might just say yes. And that might be a little bit, you know, skirting it around the gray lines, but it's actually common practice. A lot of companies do the same thing. And company earnings are very, very, very consistent for the last 5 quarters. They've just been, you know, rocket ship to the moon. And is it expensive? This might surprise you. The forward PE is 35x. And yeah, it's not super cheap, but there are a lot of companies out there. I think Amazon is probably trading at a higher multiple that are more expensive than that. So no, I don't think it's insane. Should you put all your life savings on this one stock at this particular moment? No, of course not. This isn't financial advice. I mean, my cat knows this. That one back there who's sleeping peacefully. It's our risk manager, that one there. No joke. I used to sit on a trading floor and the risk manager was sat behind me and he showed up about a week into the job with 2 black eyes. And he claimed he hit his head. Nobody believed that. But you get the idea. Risk managers are strange people. Now, Meta. Here's another sexy stock. Well, it's growing so-so, but it's so very profitable, and the cash flow's coming out of his ears. You might not like Mr. Zuckerberg very much, and what they stand for and the whole, there's a lot of stuff on Meta that's wrong. I mean, we got a great Facebook group, 6,000 people in there or something. And of course, as soon as you join it, they're like a couple of bots who'll message you as spam accounts. Meta could do something about it. They don't care, because all they care about is making Papa Zuck richer and richer. And you can follow that path by being a shareholder. And look at that gross profit margin, 80%. For a software business or an advertising business, which is what this really is, that's kind of the holy grail. 80% is where you want to be. 40 billion almost in profits, return on invested capital 24% is like fantastic. And so if they take $1 billion and they invest it, the next year they'll generate $240 million. So in like 4 years, they've paid off the investment. That's pretty amazing return, right? And then their profits are still growing 20% a year. Again, this is not a brand new business. It's pretty impressive, the growth there. So execution from Zuck's little lemmings and all the evil little Knievels who work there is tremendous. Free cash flow is glorious. And it's one of those things. I don't like the business particularly, but from a moral, ethical, personal kind of point of view, do I own the shares? Yeah. I mean, I own tobacco shares, right? So maybe my moral compass is a little bit looser than some, but 25 PE is X is the forward PE. It's not super expensive compared to a lot of things out there right now. And if you think, no one uses Facebook anymore, if you're an advertiser, you've got two choices in life. One's called Facebook, one's called Google. You're going to do both. That's it. That's it. TV, radio, print, none of that matters anymore. That's basically it. That's your choice. So these guys have just got it's a duopoly, essentially. And it's pretty much worldwide. Now, here's one we don't talk about very often. AstraZeneca. What do they make? Well, they make pills, pill-popping people. That's a great picture of a pill, isn't it? Artist at work. It's growing very nicely. It's insanely profitable. And look at that C for the value. It's very rare. You get a C, which is like a pass, right, at school, and you get that level of profit health. And I always say I don't really like pharmaceuticals. One, I think they're fishy. I think it's a strange industry. I don't understand it. I don't have a PhD in pill popping. And therefore, I just think I don't understand the stuff, so let's not touch it. But, I mean, I don't know any of these pills because I don't take any pills at all. But apparently they make a load of stuff that means something to people. Tagrisso, Infinzi, Linpasa, Calquenzi. I don't know what this language is, but it means something to some people. And, well, they're headquartered in Cambridge, UK. I went to school in Cambridge. Lovely town. And look at their margins. If you don't know anything about a business, first place to go, look at gross profit margin, because that tells you, do they have a competitor that's eating their lunch when they're not paying attention? No, they don't. Otherwise, you wouldn't get an 82% margin. And then return on invested capital and earnings growth is pretty good for an old ass business like this. And it's pretty profitable, right? That's a pretty good, what is that, 12% or something profit margin? That's not bad. 45 billion revenue. 9 billion free cash flow. They've got plenty of money to develop. They've got about 150 projects in the pipeline. Their pipeline's pretty enormous. And their valuation isn't actually insane. And I'll show it to you in a second. Now, some of these stocks have had a little bit of a miss. The ones that had massive COVID businesses. AstraZeneca didn't really have a massive COVID business. They didn't really ever get that boost. But there are some European stocks right now that I think are quite undervalued. And now, of course, there is somebody like Novo, which I also like at a stock, but fat drugs are not cheap right now, whereas AstraZeneca looks a little bit more, 16 times PE. That's probably the cheapest thing we're going to look at today. And say if you believed in the bean counting analysts and it was just going to grow 16%, 3%, 1%, 0, 0. Well, there's 192 in here, which you could obviously spread over. So it basically is all 15, 16% growth. You'd get to like a 6x multiple by 2031, which is in 7 short years, which, how does that work? Well, might be confusing. If you look at PE, P price is fixed if you buy it now, right? Whereas earnings can still go up. And therefore, over time, your PE ratio comes down, which is why you can buy good companies at high prices. It doesn't really matter. Just don't buy shitty companies at high prices because you will never be forgiven. I buy good companies at high prices, and it's basically like a Catholic purchase. You will be forgiven, son. There we go. We just offended half the world. Brilliant, isn't it? The power of YouTube. We don't offend Islam here. It's not worth it. They come after you in a different way. The Catholics will just go, "Oh, Hail Mary, let me forgive him, son, for he has sinned." You know, that kind of thing. It makes more sense to make fun out of them, right? Cash flow health on BROADCOM is insane. It's growing very nicely, and look how profitable that is. That's an A for effort, and it's a D. That's pretty good. I say you almost never ever get an A with a C, A for profit and a C for relative value, except for AstraZeneca, and therefore still like it. Well, what do they actually do? Well, they design, develop, supply various semiconductor devices, that's specific, with a focus on complex digital and mixed signal complementary metal oxide semiconductor-based devices and analog 3 to 5 based products worldwide. Run out of breath there. So basically, it's semiconductor solutions and infrastructure, essentially, that they pop out there. Fiber and all kind of connective stuff. That's all very, very exciting. They've been around forever, about 60 years. Look at their margin. I could kiss it. 74% gross profit margin. That again means there isn't some young whippersnapper going, "I can do this much cheaper than you." No, there is. Otherwise, their margins wouldn't be what it is. They have a 12% return on invested capital, which is kind of, for me, the bottom line. I like to have more than 12% here. I like to have more than 60% on the gross margin. And on earnings growth, I generally also like that to be 12% ideally. So it ticks all my boxes, and it makes me think the stock should go up sort of 12 to 14% a year, maybe a little bit more. And you might think, "Oh, that's boring, Felix. I made 1,000,000,000% last week on Bonk Coin," which is a real thing, actually. I think Robinhood just listed it. You can trade it on there if you really want to. But compound this in the long run, I think it's a decent business. I think it's something that could be in a portfolio. And 38 billion revenue, almost half of that is free cash flow. So what does that mean? It means a couple of things. It means you will never get dilution. So no dilution. They don't need to borrow money. And very likely you get buybacks till the end of time because they don't know what to do with the money, which is a pretty good place to be from an investor point of view. And has management been good? Yes, they have been. They've been very good. They've been beating market expectations consistently every single quarter in the last 2 years on both revenue and earnings per share. And is it expensive? Well, it's a 27, 28 forward PE. It's not like super cheap, but even over like 5 years of just expected year-on-year earnings growth, that becomes 13. Go forward another 5 years, that'll become like 5 or 6. So for a long-term horizon individual, this is actually not an expensive stock. So that's why I quite like it. Now here is one for you teenagers out there. EA Arts. Do you remember that? I used to play some game on that. I can't remember what it was, but they always played that. Gaming, basically. EA Arts makes gaming games, and they have insane cash flow growth. So it's very profitable, and it's not insanely expensive. So what do they put out? Well, they distribute, develop, publish games for every platform, and you might know some of these: Battlefield, The Sims, Apex Legends, Need for Speed. That's a big one. FIFA. I think that's what I used to play. Some Star Wars related stuff. I have no idea what the game is there, but you can imagine it in an NFC and UFC rather, NFL and so on. So they've been around since 1982, almost as old as me, and they have a glorious gross profit margin of 76%. They have a pretty decent return on invested capital, pretty decent growth rate, and profits are accelerating a little bit here, which is nice to see. Let's dive a little bit deeper. Slightly more than 7 billion in revenue and 2 billion in free cash flow. So it's a well-run business. It's a well-run business. It's not a monster business, but it's a well-run business. And last quarter wasn't brilliant. Could be an opportunity when management slips or something happens that slips them a little bit, but been pretty good, not massively consistent. Is it cheap? Yeah, relatively speaking. 19 times forward PE. And for some reason, analysts think it's basically not going to grow at all because somebody thinks in 2030 their business is going to collapse by 40%. And that's just a stupendous thing to put out there. That's one weird ass analyst out there who just lost playing FIFA or something. It's just like, I hate this company. I shall ruin them single-handedly. So also minus 2%. I don't know. I mean, okay. Anyway, within 5 years, you get about a 10x multiple. That's pretty decent. So I quite like it. And they could do better than that. They might be able to save some money with AI and all that kind of stuff. And here is a company that is as sexy as they come. Do you remember the .com bubble? I worked with a .com company back then. They were making chatbots, which sort of what ChatGPT is now taken over. And we had to manually basically create the logic for everything somebody could say. We had to do it manually. There was no AI. It was just people going, if you mention this word with that word, and then if the previous sentence mentioned this, then these might be the outcomes we want to spit out. It was rather tedious. Anyway, Oracle was the NVIDIA of 1999, right? It was worth more than the rest of the world combined, and we would not be able to switch on a light bulb without Oracle ever again. And it was the only company that could ever do and power the internet, and nobody else ever could, ever. And it was going to always be worth a gazillion times X. Just a bit of a cautionary tale around NVIDIA. And it's growing so-so. It's very profitable, and it's not insanely expensive, and the share price is sort of floundering a bit. And that's kind of why I quite like it. And, well, they just put out, if you listen to the last earnings call, they basically said, look, we're building cloud computing and infrastructure and everything else, and AI is making the demand. They basically said, we're going to be a high growth company for the foreseeable years. And they're saying we have no competition in what we do. So that's pretty bold statements from management, which I quite like, and it's definitely worth looking into. And but yeah, it's basically cloud infrastructure type stuff. The margin is insanely wonderful for a business that old. I haven't got ROIC data here, but it's growing 15% on profit. And according to management, that is going to moon as revenue growth is going to continue to skyrocket. So it might be something worth looking at. On 50 billion revenue, they bring in 10 billion free cash flow. So again, they haven't got any issue bringing in money. They're not going to dilute you or any of that. And management has been very consistent here the last year and a bit, which is kudos to them. And you know what? This chart's upside down. How confusing. It's trading at 20 times PE right now, which isn't one of the cheapest stocks we're looking at here, right? And it's in the cloud AI kind of infrastructure space. So that's why I thought I'd throw it out there. It could be a worthwhile addition to certain portfolios. And here's another dinosaur. We're going to get onto some other smaller ones here in a moment as well, which will be interesting. Now, IBM, International Business Machines. They built machines, not computers. That's how big they were back then. And it's very profitable. Growth so-so, cash flow so-so, but it's very, very profitable and it's relatively cheap. So why is that? Is IBM dead? No, it's not really. They basically have a fairly diverse business nowadays. So it's software, it's consulting, which makes a lot of money. And then there's infrastructure, and then also they finance. They offer financing for everything. So they have a cloud platform. They are in the AI thing. And you might think, look, this is old stuff. I only want new stuff. But look at this. They are integrated essentially with vendors, as like Adobe, Amazon, AWS, Microsoft, Oracle, Salesforce, Samsung, SAP, and so on. They're just in there. Their roots are so deep. You're not going to get rid of these guys. And everybody at the moment is clamoring for whatever cloud capacity they can get their paws on. And IBM is there, and they've been doing it for about 95 years. Gross profit margins are pretty good. 55%. Could be better, but it's pretty good. Return on invested capital is ticking up to 10%, and profit growth is also accelerating, which is nice to see. It's a little on the low side, right? So you have to think, well, this is going to be cheap for me to want to look at this. Revenue, just over 60 billion, of which 12 billion is free cash flow, which is a very nice improvement over the last 2 years. So well done, management. And management has also been very consistent on earnings per share and revenue. I mean, 80 million on 14 billion is like, you know, postage budget or something. It's trading at 19 times forward earnings. That's relatively inexpensive in this space. Relatively inexpensive. And if you think that the irritating analysts who are expecting 5% or 2% or 3% growth are right, that still gets you down to a 16x. It could be a lot less if growth comes in higher. I mean, a lot less. It could be 10x or more. So I quite like it. Now, how do you feel about Splunk? Splunk is a business maybe not everybody knows about. Here it is. Here's the website. They are essentially safety, security, cybersecurity, and reliability. And they work with small companies such as Intel, Zoom, Carrefour, the French retailer, Nasdaq, Stripe, Slack, Hyatt Group, Porsche, Domino's, Coca-Cola. You get the idea. Airbus, AWS, and so on. So they clearly have a product that is not shabby, and it's basically all around. It's all around security and monitoring and predicting what your users are up to and trying to weed out the naughty ones. It's growing insanely well. It's very, very profitable. It's got decent cash flow. It's not insanely expensive. So let's look into Splunk some more. So they basically, it's unified security and observability. So it's spying on your users in a hopefully good way so you can preempt attacks rather than react to it. It's got an almost 80% gross profit margin, which is the gold standard in software. Revenue is growing very nicely. They've just become profitable, which is nice to see. Profit growth at 26% is pretty extraordinary. And 4 billion revenue, 260 million profit for the first time in the last 12 months, and $1 billion free cash flow. It's very impressive. It's a well-run business. Kudos management. And they've been beating all expected. Look by how much they beat on last earnings, by like 30%. So they are doing a very, very good job. I think that's what the numbers say to me. And you know what? It's not crazily expensive. It's trading at 25x, which is, not super cheap, but if their growth 350% year on year, their growth flows to these weird like 3% or 9% or 5% or 6%, which is just some slightly depressed analyst who's going, I hate my job, I'm going to downgrade everybody. And if you believe that growth trajectory, which could be significantly better, you'd get to an 8x in 10 years. If it was a little bit better than that, it would be like a 3 or 4x. So it'd be an absolute steal if you just had patience and held on to the thing for long enough. So I quite like it. So Splunk it is. Of course, none of this is financial advice. And seriously, come and learn with me how we make money no matter what the market does. Up, sideways, down, hedging, all of it. It's all much, much simpler than you think. You should have been taught it at school, but you weren't. So we are doing it here. felixschwanz.org/webinar. Come and join me on Tuesday live. And I love you for joining. I love you for abusing and fiddling with the various buttons that you've got in front of you. And I hope to see you on the next one. Take care.